Imagine waking up to a life where your money is literally doing all the heavy lifting for you, where the old school idea of trading time for a paycheck is completely replaced by notifications of dividends just hitting your bank account. Welcome to This Explainer. I'm absolutely thrilled you're here because today, financial freedom isn't going to be some fuzzy, far off dream. We're going to break down a real mathematical game plan that you can actually build toward. So let's get focused and build some real financial independence. Okay, let's dive right into this. $4,000. Now, I know living comfortably means totally different things to different people, right? But for a vast majority of us, generating 4 grand a month, which is roughly $48,000 a year, in pure passive income, that's the ultimate aspirational goal. It's that magic threshold where you can realistically start covering your everyday living expenses without relying on a traditional 9 to 5 grind. So here's our roadmap for today. First, we'll nail down that $4,000 dividend goal. Then, we'll explore 3 different paths that balance risk and time. We've got the safest path with dividend aristocrats, the middle ground using REITs, and finally, the fast track with covered call ETFs. At the very end, we'll compare all your timelines. Let's jump in. Section 1, the $4,000 dividend goal. Let's build that foundation. Let's keep this super simple, because dividends often sound way more complicated than they actually are. Look, a stock isn't just a lottery ticket or a piece of paper. It's a slice of a real functioning business. When that company makes more money than it needs to keep the lights on, it can actually share those excess profits with its owners. And that cash payment, that's a dividend. It is literally your direct cut of a company's real-world profits. Now, let's talk about dividend yield. Yield tells you exactly how much income an investment produces relative to its current price. Think of it like this. If a stock costs $100 and it pays you $10 a year in dividends, your yield is 10%. Make sense? Yield is going to be our ultimate measuring stick today because it lets us compare our income potential and really understand the core trade-off of investing. Do you want more cash up front, or are you looking for long-term growth? To make this explainer as practical as possible, we need a grounded, realistic benchmark to run our math through. We're not going to just assume you have $1 million sitting around, because who does, right? Instead, our baseline assumes a $20,000 initial investment, plus adding a very accessible $10 a day. And here's the absolutely crucial part. We are assuming that every single dividend payment gets reinvested straight back into the portfolio. That's what allows your income to continuously compound upon itself over time, like a snowball rolling down a hill. Moving on to Section 2, the safest path, dividend aristocrats. This is all about the slow, steady, and reliable approach. The absolute most important thing to grasp here is that incredible 25-year track record. A dividend aristocrat isn't just some random company that pays a dividend. It's a company that has increased its payout every single year for at least a quarter of a century. I mean, think about that. Through recessions, massive market crashes, economic slowdowns, you name it, these companies just keep paying. This specific path is custom built for those of you who prioritize absolute recession-resistant reliability over quick cash. So looking at the engine powering this path, we've got 3 incredibly high-quality holdings. First up, Lowe's, bringing a massive 16.07% annual dividend growth. Then we have NextEra Energy, adding some incredible stability through the utility sector. And finally, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, which spreads our risk across dozens of established companies. When you combine these 3, you're looking at a highly dependable portfolio with an average yield of 2.67%, plus a staggering 12.02% in average annual price appreciation. But we've got to talk about the major trade-off here. On the one hand, yes, you're getting highly dependable, sleep-at-night, recession-resistant growth. Your wealth is secure. However, look at the reality of the math. Because that starting yield is relatively low at 2.67%, if you wanted to generate $4,000 a month instantly from this strategy, you'd need almost $1.8 million in upfront capital. And let's be honest, that is a massive barrier for most people. But watch how the magic of compounding plays out over time with our benchmark. By year 10, your disciplined investing has grown to over $152,000. Pretty good, right? But to reach our ultimate goal of over 4 grand a month without selling off any of your assets, it takes 27 years. At year 27, the portfolio reaches nearly $1.9 million, paying out $4,334 a month. So it works beautifully, but man, it requires immense patience. Section 3, the middle ground, REITs, balancing income and growth. So what exactly is a REITs? Well, a real estate investment trust is essentially a brilliant way for you to collect higher upfront cash flow from large-scale real estate without ever having to actually manage physical properties or, fix a leaky roof at 2 a.m. These companies own huge assets like massive logistics warehouses or commercial billboards. They collect the rents, and by law, they are required to pass a huge chunk of that income directly to you as a dividend. It's a pretty sweet deal. Let's break down the specific holdings for this moderate path. We've got Prologis anchoring us with global supply chain warehouses. Then there's CTO Realty Growth, which is pumping out a massive 8.41% yield. And Lamar Advertising is bringing in cash from outdoor billboards across the entire country. When you blend these together, you get an average portfolio yield of 5.53%. Notice that jump? That is more than double the starting yield of the aristocrats we just looked at.
Now, the absolutely crucial point to understand here is the trade-off of walking this middle ground. The upside? You get paid much faster, and actually a lot of REITs pay you every single month. Plus, you need significantly less upfront capital, around $868,000, to instantly hit that $4,000 goal. But the downside is you have to accept greater sensitivity to broader economic cycles. When property demand shifts or interest rates fluctuate, your portfolio is going to feel those bumps a lot more acutely than the aristocrats would.
But check out this dramatic timeline reduction. Applying our exact same benchmark of $20,000 and $10 a day, that 5.53% yield totally turbocharges our compounding. Look at year 17. Bam! You hit the goal, reaching over $4,400 a month in just 17 years. Simply by accepting a moderate amount of economic risk, you've successfully shaved an entire decade off your journey to financial freedom. That is huge. All right, Section 4, the fast track, covered call ETFs, maximizing your income speed. Let's briefly demystify this one because it's a really fascinating financial tool. A covered call ETF doesn't just rely on traditional company profits. Instead, they generate massive amounts of upfront cash in two distinct ways, through regular stock dividends and by selling option premiums. Basically, the fund agrees to sell its stocks at a set price somewhere in the future. Someone else pays the fund cash up front for that agreement, and the ETF turns around and passes that cash directly to you as a massive yield. Just look at the incredibly high yields on these specific holdings. We're talking about utilizing funds like JPQ, PBP, and XYLD. Every single one of these funds is yielding over 10%. When you combine them, you achieve a massive 10.67% average yield. Make no mistake, this specific portfolio is entirely engineered to completely supercharge your immediate cash flow from day one.
But remember what we said earlier, every strategy has a cost. The clear benefit here is maximum income speed. To hit $4,000 a month instantly, you only need roughly $450,000 up front. That's the lowest capital barrier we've seen by far. But look closely at the catch. The huge sacrifice here is your capital appreciation. Because of those options contracts, your actual stock price growth is severely capped, averaging a mere 4.3% in growth, especially during strong bull markets. You are essentially trading future wealth for immediate cash today. And here is the absolute climax of our timeline escalation. Look at how fast this moves using our benchmark investment. By year 5, you're already sitting at over $71,000. And by year 10, you cross the finish line. You reach an incredible $4,591 per month in dividend income in a mere 10 years. This high-yield strategy turns capital into income faster than literally anything else we've discussed today. Section 5. Comparing your timelines, speed, stability, or income. So here is the total mathematical picture. This perfectly displays the ultimate trade-off triangle we've been tracking all along. You can choose the rock-solid stability of dividend aristocrats, knowing full well it'll take 27 years. You can take the middle ground with REITs, shaving it down to 17 years by taking on just a bit of moderate economic risk. Or you can go for maximum speed with covered call ETFs, hitting the goal in just 10 years, but sacrificing almost all your long-term price growth to make it happen. So what does this all mean for you? Well, the crucial takeaway is that there is no single perfect investment in the world. There is only the perfect investment for you. As we wrap up this explainer, I want you to ask yourself, which path truly aligns with your personal timeline and your unique risk tolerance? Are you trying to build a 30-year recession-proof legacy, or do you urgently need to maximize your cash flow over the next decade? The math is sitting right in front of you. The only real question left is which path will you choose to start walking down today?